Hello and welcome back to All Things Money. I'm your host, David Blain, and during this segment we're going to continue our discussion about the Federal Reserve and central banks, how they got started, and some implications for today. If you missed the last segment, head on over to the website, www.dlblain.com, and you can catch up. We'll post an archive copy of the show in a couple days. So we're talking about the central bank and how they got started as a depository for gold so that companies could conduct commerce around the world using paper money instead of having to carry all that gold around. And of course, that's more today into everyone uses that, but the central banks, the premise is based on the confidence that the central bank has enough assets really to prevent the devaluation of the money should inflation come into play, that no central bank has enough gold in their reserves to implicitly back their paper currencies. And so while Europe has had this central banking system since the 17th century, the United States did not actually have a central bank until the beginning of the 20th century. Some of our early founding fathers really warned against it. If you look at some of the writings of Thomas Jefferson, some other people, they really warned against the tyranny of the central bank. But anyway, as a direct result of the panic of 1907, the Federal Reserve, the progressive political movement, created the Federal Reserve in 1913. And and under this Federal Reserve system, that they not only allow the Federal Reserve to keep gold as backing for the dollars that they printed, but they include short-term bills of trade such as bankers' acceptance, commercial things, and they were able to expand the definition of the Federal Reserve's assets, and so they had the ability to increase the money supply once again by increasing the definition of what constituted a reserve away from just gold to include some short-term debt. They were able to print more money. And this was able to provide more credit available to the markets. And this incremental increase in flexibility was designed to reduce the panics that had happened throughout most of the 19th century under the gold standard. So the gold standard is not perfect. You had these panics. But during the Great Depression of the 30s, the Federal Reserve really, in my opinion, got out of control. In 1934, the Federal Reserve revoked the note holder's right to convert paper into gold on demand, and really unexpectedly seized all the citizens' gold holdings. People were required to turn their gold in. I did a show about this before. People don't realize this, but go back, Google it or whatever. Back in 1934, U.S. citizens are not allowed to own gold. It's very, very disturbing. And anyway, then they arbitrarily revalued the price of gold to $35 an ounce. And so we had a lot of turmoil, but nonetheless, the Federal Reserve still held gold bullion as its primary reserve asset. In 1935, the Federal Reserve was granted temporary emergency powers, allowing it to be using Treasury securities, government debt as a reserve asset. So you see, we've moved from gold to bankers' acceptance things, and now then they revoked the right to convert the currency over to gold from the citizens, and now they want to use government debt as the backing of the currency. It just sounds kind of, if you take it at face value, using government debt as the backing for the currency. And so, anyway, this was a huge expansion in the power of the Federal Reserve and what they could use to back it. And the Treasury reserves had, much more risk involved in them, mostly interest rate risk. At this point, there was no question as to the stability of the U.S. government. But by accepting government securities as asset backing, you introduce interest rate risk to the currency. And we see that the central banks tried to maintain their debt-to-equity ratio during this time, the 1930s. It started out very low. Up until 2008, it was probably somewhere in the 20 to 1 ratio, meaning that they had, for every dollar of gold, they had about $20 worth of dollars floating around in circulation. Now, a 20-to-1 debt ratio, is certainly better than where we are today, but that is not, that's a lot of debt. That's a lot of leverage. When we talk about leverage, the average debt ratio for a company, we'd like to see a little bit lower than that. But when we see that in 2008, the Federal Reserve had about $41 billion in capital and $872 billion in liabilities, so a debt-to-equity ratio of roughly 21 to 1. And that included $480 billion of Treasury securities. So if interest rates were to go up, it would decrease the value of those assets, and a loss would be devastating, but not completely crippling. Well, we see that in 2008, this monetary policy that had survived for basically 90-some years, basically evaporated. And by 2011, the Federal Reserve had more than $2.6 trillion in Treasury and agency securities, mortgage bonds, other things. And now the leverage ratio was about 51 to 1. And so now the risk of rising interest rates and the Treasury owning all, or the Federal Reserve owning all these Treasury securities, the risk of rising interest rates is very severe. If we have a rise in interest rates that is unexpected or not well controlled or very rapid, you could see the value of the Fed assets plummet precipitously, and to the point where they could technically be bankrupt. Now, I don't want to cause a panic here, but this is the problem with the Federal Reserve and some of the issues that you hear as we moved away from the gold standard and using other assets, namely government debt, to back our dollar rather than actual assets. And if this happens, if the dollar starts to weaken against other currencies, its use as a reserve currency around the world, people use the dollar to transact in goods and services all over the world. It threatens that stability, and it's sort of this snowball that could call into question the stability of the currency. People also, from foreigners investing in U.S. Treasuries, they could pull back, and once again driving the price lower of the asset that backs the security. So you have a lot of factors going on there with the Federal Reserve using U.S. government debt to actually back the dollar. Well, that's about it. We're out of time. That's a lot to cover. Maybe we'll pick up on this topic again next week. So for All Things Money, I'm your host, David Blain, and I hope that we'll see you again same time next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.